Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. All right, everybody, welcome to our Tuesday Night Podcast. We're live, special guest Melody Wright on tap here. And tonight we're going to talk about a lot of interesting things. One is going to be what FHA, HUD is working on with FHA mortgages that are defaulting. We're still looking at massive defaults are up in the housing market. And, but guys, everybody wants to tell us everything is okay, A-okay. Mainstream media says, hey, the economy's doing wonderful. We've got, Fannie Mae coming out with, actually, I think it was Freddie Mac. Who was it? It was Fannie Mae. Yeah, National Housing Survey. By Fannie Mae, and asking what the consumer sentiments are in the housing market or just in the economy in general. And I think most people think it sucks. I think most people are smart enough to realize that the things that we're hearing isn't really, what people are feeling in their pocketbook or their pockets. And I think everybody is realizing that we're in a mess. We're in a government. We have a government that is in the biggest debt ever. We have consumers that are in the most debt ever. But yet we hear, all these things come out about how the housing market in 2024 is going to be so fantastic and that the Fed is going to drop rates. And we're going to talk about what we think about that. What if it's a little bit too late for the Fed, just like in 2007, right before the massive housing crash. The Fed dropped interest rates, the Fed rate to 1%, somewhere around there, and it didn't help. It didn't work. But anyway, we're going to talk also about, everybody says if interest rates would be so much better, buyers would be jumping in and we would start seeing, the housing market, doing just fine. But the point is, and we're going to talk about this too tonight, is that the new home market has been dropping interest rates for months. They've been buying down rates at 2%, levels of 2%. So, other words, if, interest rates are 7.5% for a 30-year mortgage, home builders were dropping it to 5.5%, doing a 2-year buy down for the homeowners, costing $20,000, $30,000. Lennar is one of them that was offering rate buy downs and didn't help the housing new home sales at all. In fact, they still had to discount home prices. And nationwide, October, we had a new report that year over year, new home prices declined, to the biggest decline that we've seen in decades. So anyway, we're gonna get to a lot of this tonight. We're gonna talk about your comments, excuse me, and questions. That was happening earlier. I think Melissa's she's wearing something I'm allergic to. But anyway. Melissa.
Hello.
That's
Hello,
a good
Todd.
key in for you.
Yes.
Come on in.
Let's keep our wellness here at the office. But Melody, so awesome to have you. And you guys are really not having what mainstream media has said. I'm just going to pull up a comment here to kick it off tonight. I refuse to give my money away in the form of high taxes and insurance. The bus stops here. Stand your ground. And you guys, I'm going to be filtering through your comments and questions this evening. We know you're not happy. We know that many of you are wondering when are the prices going down, when is going to be the good time to buy, what's going on in the future. We're about to walk into 2024. Looking forward to an awesome show this evening. Yeah,
so Melody, come on, man. Let's start this party right. Tell everybody who you are.
Hi, I'm Melody Wright. I'm a housing analyst. I talk about mortgage finance, commercial real estate, and housing. So I'm here to just chat with you guys about the latest and greatest or not so great news that we've been hearing.
Yeah, so Melody, how long have you been in serving the housing industry? You were back in the '08 crisis. So tell everybody a little bit about what your role was, because it's kind of important. I mean, you were dealing with the mortgage fallout, and it's interesting because we know that FHA is really the subprime mortgage market, right? I mean, so they sort of took over what we had back in the leading up to the crisis, where we had like Lehman Brothers and Countrywide Mortgage and
New
you know,
Century,
yeah,
TBW. Yeah. Yeah.
exactly. So tell everybody what your role was back then and how critical, just to lay some context tonight, like what you did, what was your role back then when it really hit the fan?
Yeah, so I started in corporate finance at one of the largest subprime originators in 2006, having no idea how I fell into that. So it was kind of crazy, but at the time we'd just been purchased by private equity Cerberus. They got in at the top. We'd made our parent company GM a lot of money. We were, going gangbusters, similar to the COVID boom. But as Cerberus purchased us, they saw the market turning and they wanted to do a purchase price adjustment. And so very quickly, my job just kind of became, I was their sidekick going out across the company, learning about the business, because we had a bunch of different disparate companies that had come under the umbrella. And so, 2006, we had a couple of months. I went to a party where there was a big Lego house and there were balloons. And it was like, I sat down and I turned to my colleague and I said, "Is this Enron?" It was that crazy. But it was a celebration of what had just happened. And, just a couple of months later, we're talking about write-downs, and we led the write-downs because of Cerberus wanting that purchase price adjustment. So we were very early, comparatively speaking, to the big boys like Chase, Bank of America. We were part of the big five, but we kind of led all of that. And so it was pure bananas. You would walk into the office and it would be like, "We're writing down $800 million again today."
Explain to what that means. Explain what a write down is. Explain what a write down is.
Sure. So it's like when you when you have these loans, they sit in what's called held for sale or held for investment, depending on what you plan to dispose, how you plan to dispose of these assets. But, a lot of times, and in mortgage, Todd, Melissa, you'll understand this, you have what's called the pipeline. It's a massive pipeline of what's been basically the app's been taken, then it kind of comes through the pipeline to get funded. And then typically you're going to sell it for, back then, you were just going to sell it for, securitization, however you're going to get the best price. And that could have been a private label securitization. We don't have a lot of that anymore. It's about 5% of the market right now. Or it could have been to the government sponsored entities, enterprises, Fannie Mae, Freddie Mac, or through Ginnie Mae.
Right. And just so everybody knows, so you're talking about once the loan is underwritten and it's approved, you're talking about selling that mortgage to the secondary market. So you're a mortgage originator, you package everything up, and then you need to sell that loan, and that's where these mortgage originators make their money, right?
Correct.
They actually, during the origination process, then they sell it off. So just kind of explain like that. So now we're in the write down. So what you had said also was that really the private sector, the private investors right now, you said are only about 5% of the market. That means that the government is buying all of these mortgages, correct?
That's correct. And so, I don't think a lot of people understand that completely, but, it has changed. And so private money kind of left. They're a very small percentage. And it kind of became just the government show. But essentially what would happen is you would have these assets. And so our write downs could be our mortgage-backed securities. It could have been our other trading securities, because when you're in this business, you're hedging as well. So you have currency contracts, you have trading securities, and of course those mortgage-backed securities. And so one thing that's very different now is that really because of Basel III, which is, sort of these guidelines the banks have to adhere to, it doesn't behoove the banks to hold those assets on their balance sheets anymore because of the capital ratios. So essentially, like a servicing asset is going to be a higher risk weight. And that's one of the reasons the banks have gotten out, and a lot of the non-banks are doing this stuff now. But essentially, you had all of this on your balance sheet, and because of these losses, because of, the deteriorating credit quality, we would have to write down that asset. So to put it simply, if you had $1 yesterday, that dollar might be worth 25 cents the following day, and so these were just it, and that was every single day. And I think a lot of people kind of don't understand that. Of course, yes, it started out as the subprime or non-prime, but then it really impacted your prime borrowers as their credit quality deteriorated due to increasing property taxes and insurance, just like we're seeing now. And so, I used to tell people a couple of years ago, it's like, sure, credit quality looks great. It looked great in 2006 for a lot of our borrowers. And then they became upside down as on the one hand, those property taxes and insurance were increasing, but, on the other hand, prices were dropping. And so they had a ton of equity, and 6 months later, that equity was gone, and they didn't do anything to cause that. It was just because prices were declining.
I explain a lot about when we're looking at the current housing market, we're at the highest pricing level that we've ever been. So, we're in such a bubble, and, it's hard for people to understand this. And, they think that home prices can't correct. When we look at Dr. Schiller's, home value, or average home value, or what home value should be to wages, we know that, we're like 120, 140% higher than what the median home value really should be right now. And we know that you need to make, a lot more money to afford a home today, and their houses are trading at like 7.5 times median household income, and that's just the highest it's ever been. So when we're talking about home prices and the need for a correction, it really doesn't have anything to do with interest rates. We can dive right in. The Fed, there's a lot of pressure on the Fed right now. Home builders, the mortgage industry, the NAR, everybody, the pressure is, oh my gosh, the housing market, we need some relief in, the cost of, what we really need are home price corrections. And I just want to take a look at the poll, and we'll check this, but we had a poll out there asking everybody, hey, what do you guys think is more important, home price or interest rates? Joe, maybe we could take a look at that real quick and see what everybody said, because really what we're looking at today is if the Fed, in my opinion, drops interest rates, and we even have a 5 in front of it, I think that buyers, smart money right now, the people have cooled off. The demand has cooled off so much. Everybody agrees that home prices are too high. Here we go. 80% so far. You guys can vote still. We're going to keep this poll open. 210 votes and counting. But 81% of you said that, hey, home buyers, what's more important to you, lower home prices or lower mortgage rates? And we all know that, the price is really what matters, in real estate. If you're, talking about the old cliche, what investors always went by, and why would homeowners be any different? It's buy low and sell high. Why do you want to buy high and sell low? It doesn't make sense. And when we look at where we are right now, we could really see a big correction. Melody, let's talk about bailouts. What would have happened if we hadn't seen, all of the government bailouts and the mortgage moratoriums? Where would we be right now?
Probably somewhere sane, Todd. And which bailout are we talking about? 2008 bailouts or?
Yeah, I'm talking about right now. I'm talking about the bailouts of 2 million people that, the government has bailed out. 2 million people households have been bailed out since the pandemic.
So, where would we be? We'd probably be in a logical place. Right now, this just it doesn't even make any sense. And I think when the Fed started buying MBS is really what, threw it over. And you had people participating in the market that, quite frankly, really shouldn't have been, So, for instance, I'm just going to do a hypothetical. Let's say, you've got this property you can't pay, but you go ahead, you get your refinance, and then you do a forbearance. And in that refinance, if it was a cash out, you could have gone and actually probably bought another property. And because you're on forbearance and not getting negatively impacted through your credit score, you could just keep borrowing and kind of keep the cycle going. So, I think that we would be somewhere much more rational had we not gotten bailed out.
You think the bailouts are going to continue?
I absolutely do, especially as we're in an election year. I think they're just going to we saw how quickly the VA moratorium occurred. It was a matter of days for that to happen. So,
yeah. Do you have werewolves in the background?
I'm so sorry, guys. I have a farm dog named Buddy that howls at the moon. Sorry.
He's a werewolf. Let's check out this article here. This article on Housing Wire. Actually, a lot of people don't know this right now, but this is as of October 18th. But actually, Joe, let's go ahead and look at the National Housing Survey first. Let's pull this National Housing. No, that's not what I'm sorry, guys. I'm pulling up the wrong thing. FHA mortgage reduction. That's where I want to be, Joe. So Investopedia.com. So let's take a look at this. FHA mortgage reduction plan may lower monthly borrower costs without pricey refinance. Guys, this is right now, this is being proposed. So this started in like May. The FHA or HUD put this out for comment. But basically what they're preparing for right now, they're hoping to have an answer by the end of the year. But they actually want to come up with this new stimulus program. So this proposal would let borrowers catch up, reduce mortgage payments for up to 5 years, guys. So borrowers could lower their monthly mortgage payments without having to refinance at decade-high interest rates under a new proposal from Federal Housing Authority. So basically what they'll do is they'll get this credit on their monthly payment. And I've seen things like up to $1,000 a month. And they'll basically, at a minimum you have to do is a minimum of 3 years, a maximum of 5 years. They'll basically give you a credit on your mortgage payment to reduce your mortgage payment, and they'll dump that balance on the back end. And essentially you have to pay it off if you go to sell, or you end up paying off your house. But this is called the Payment Supplement Partial Claim Proposal. And what do you think about this, Melody? Have you heard about this?
Yeah, I've heard about it. It's just the latest. The 40-year mod's not enough. In my client portfolios right now, we have people on the 40-year mod who've already taken their partial claim, et cetera, and they're still not able to perform. And so essentially this is just really elongating the process. To me, this is not a rational plan.
I mean, here we think about it. And this is, it used to be for COVID forbearance, right? It's sort of like hey, you were affected in some way financially with COVID. I mean, that was 3 years really of forbearance. We know that the mortgage forbearance ended last month in November. The last time you could apply for it was in the end of May, 6 months of no mortgage payments. And now what I'm curious is why we're not hearing this on mainstream media. Why, when they're talking about how the economy is doing so great, why FHA feels that they need to cut $1,000 off of your mortgage payment for a minimum of 3 years if you enter this program, but up to 5 years. If we're doing so well financially and our job market is so strong, why would we need to continually bail out? What's the percentage of FHA mortgages in America? Do you know?
It's about 16 to 17% of sort of the outstanding mortgage-backed securities.
So 16%, 17% of all mortgages. And so they said that this program may be extended to Fannie and Freddie.
Yeah, I wouldn't be surprised because you can't, they had HARP last time. I don't know if you remember that, the Home Affordable Refinance Program. But because of where rates are, that wouldn't work. And so, I'm not surprised that this is kind of what they're doing. I knew that they would sort of come out with some sort of creative programs, especially as we go into an election year. I mean, they don't want anyone sort of struggling. But to your point, Todd, the reason that we're not hearing about it in mainstream media is because then they would have to admit that, we've got 9% delinquency in FHA right now. So, that's not something they want to admit. And, essentially that FHA has taken the place of the prior subprime.
I mean, when we look at this, so you're saying 9% delinquencies in FHA. Mm-hmm. And is that serious delinquencies over 90 days?
That's full 30 to, 90 plus.
Okay. So total, people that are late on their mortgage, we've got almost 10% of FHA mortgages are in arrears. They're in some type of delinquent form. That's despite the fact that we had the stimulus, mm-hmm. that we had the CARES Act when first of all, people didn't have to pay their mortgages. There was a mortgage foreclosure moratorium. You did not have to pay your mortgage until the end of July of 21. You did not have to pay your mortgage, right? They were doing all kinds of different things you could not be foreclosed on. And then they had the 6 months of forbearance where you could delay your payments for 6 months. And then part of the CARES Act gave up to $50,000 on top of that per household after the moratorium, where they could apply 5 questions to answer on the website. Do you live in the state? Do you have, are you delinquent, or is the mortgage, do you own the mortgage? Is your primary residence? Are you delinquent? Right? There was a couple of 5 questions to answer. If you answered all the 5 questions correctly, you're eligible for up to, I hear in Maryland, $50,000 per household. That's on top of that, right? I mean, this is crazy. We're going into 2024. Pandemic started in the beginning of 2020. Now they're saying the economy's great. We're going to soft land. Come on, man. We're going to soft land this. And now we're talking about giving FHA, it'd be extended, a reduced mortgage payment on top of a 40-year modification possibility, right? 40 years, take your mortgage to 40 years, cast 30% of your balance on the back end. We're now talking about reducing mortgage payments even more, up to 5 years, ladies and gentlemen. And you're telling me we're in great shape. Not you, Melody, but everybody wants to say the housing market isn't going to crash. Let's talk about what happens if the Fed drops the rate. What do you think, Melody? What's going to happen if the Fed drops the rate? Do you think the Fed's going to drop the rate?
Yeah, Todd, I mean, I'm a little different than, after studying the Fed and sort of really diving into this, I no longer really look at them as the ones in control. I really look at the bond market as what's in control. And we've seen these recent moves, right? The 10-year, this has been a massive move in the last couple of weeks. And so in reality, if they drop the rates, I think we were talking before the show, to your point, it's likely not going to help. I think rates are coming down no matter what the Fed's going to do in terms of mortgage rates. Let's be specific, right? And so to me, that's already happening. And so now I don't think the Fed has much control over that except for how they try to manage the message, personally.
What about, let's play this out. What do you think is going to happen to the 10-year bond, Treasury bond?
Well, so right now, it definitely has a sort of, its move is down, and I think barring any sort of kind of crazy, something that maybe happens in Japan, et cetera, I think this could continue its way down for some time, or, get down below that 4 handle in the 3 range. We shall see, right? But it's definitely not going up at the moment. And there's definitely seems to be some momentum. And so where it actually ends up, I can't tell you, but I can, I don't believe that it's going to end up above that 5 handle. I think we have, we've kind of broken that sort of higher range. And now the momentum is definitely to the downside.
Yeah. Well, let's kind of talk about what happened in the '08 crisis, because a lot of people want to just kind of glaze over that. And I really want to talk about buyer sentiment, because as someone that went through, both of us went through that market. And, when we saw, a couple weeks ago, we showed the housing affordability index. And, right around the 100 line on the housing affordability index, what that means is that someone with a median household income can afford a median priced home. And, even when we were in that period of time, when we were looking at the lowest housing affordability in 2006, because that was kind of the peak, we never dipped down below 100. Since 2021, for the first time in 23 years, we dipped down below that number of 100, meaning that we are, the median household income can't afford the median home price. And, so if we just consider the fact that, and here we go, Joe's just pulled it up here. You can see in '06 what I'm talking about, where, that line at the 100 wasn't breached back in '06. And that was the height of the housing market. So when we looked at to date, when we looked at, the housing bubble, that was definitely a bubble. We know that this bubble was way bigger than '08, but we still didn't breach the unaffordability index like we're in right now. And we know now that ahead of, whatever kind of downturn that we could see in the housing market, softening of prices, that we already know that mortgage bailouts are essential or people would be bust. We would be, if you guys don't think that we would be in a massive crisis right now had the Fed not stepped in and said no foreclosures for years, bailouts for years. And now they know that the housing market is struggling. Homeowners are struggling so bad that they need to even think about this new program that they're hoping to have a solution by the end of this year. Of course they do, because we're coming into an election year. But when we look at this, we know that the affordability is down. Now, leading up to 2006, we had an exuberance that we had in 2021. We had the same exuberance where people were overbidding, competing. I didn't see the overappraised price addendums. That became something new. I think the real estate industry invented that. I think real estate agents invented that. Like, in conjunction with, loan officers, because they wanted to continue this market. So I think together, I don't know where this overpriced idea came that how much will you give over the appraised price? I didn't see that in 2006. Mm-hmm. Even though we saw craziness going on, it wasn't that. Of course, we're going to have a lot of remorse now because we didn't do that back in '06, right? But now that we've done that and we raised the bar even higher on mortgage prices. Well, now we know that the Fed is the FHA is our new subprime operator. So they can bail themselves out where Lehman Brothers couldn't. I mean, they had to go bust, right? They didn't have the machine to print money, right? They didn't. So what happened was the government kind of picked and they chose who would be the winners and who would be the losers. So now the FHA can come in and say, well, we're not going to lose because we have the power and the control to now modify everybody's mortgage payment. But here's the problem. The problem is we're still not forgetting about the rest of the buyers and sellers, because there are a lot of these FHA borrowers that are going to want to sell. Mm-hmm. And there are also a lot of other sellers that are going to want to sell, and they're not selling because they're waiting for the rates to come down. Well, the issue that we have here is that buyers are completely disgusted. The buyers that I talk to they're tapped out. They have the money to buy, but they're refusing to because they don't want to overpay. And this isn't just people that are listening to my show or somebody else's show. These are people that are smart. They're saying, you know what? I can read the writing on the wall when the Fed stands up and says the housing needs a correction. And when we know that houses are trading at 7.5, 8 times earnings, doesn't take a rocket scientist to figure out it's not just low rates what people want. What they want is the availability of inventory. They want to pick and choose because they watch people make bad decisions on buying lots and houses that they would not have bought had there been more inventory to choose from, right? They're remorseful because of that. So buyers today want more inventory and they want cheaper home prices. Now, just like in 2007 when the Fed dropped the rates, it didn't help. It wasn't just the fact that people couldn't afford to buy. People realized that home prices were overvalued and they wanted better prices. So that is what we need to be faced with. Is that going to happen again this time? Are the buyers on the sideline, the ones that have been saving their money, the ones that are ready to strike? We already said that new homes have been dropping interest rates by giving rate buy downs. That didn't work. That hasn't made them excited. The buyers aren't excited to jump into that. So we know that rates maybe don't matter right now, except they need to come down too. Melody, what do you think about that? Do you think if rates drop, do you think the buyers are going to be so excited to jump back in and overbid and compete and raise the prices up another 20%? Or do you think that an increase in inventory is going to happen when rates come down because of seller demand and that we're going to have more inventory than buyer demand?
No, I think we're definitely going to have more inventory than buyer demand. I think that, as you were rightly pointing out, Todd, the new build sales have slowed. Those buy downs aren't working anymore. We're actually seeing price declines, which is, I think, stark because, as you've talked about on your show, when they enter it into the MLS, they don't have to put all the concessions, or at least that's what I've heard. And so the fact that we're seeing real prices come down is I think very telling. And so I think as rates do decrease, that your sellers are going to hit the market. Your new build, which is on steroids to deliver because they've set out numbers to the street of what they want to deliver this year. And then people are kind of waking up finally to the fact that they don't want to carry that second, third, fourth home anymore because of the increased property taxes and insurance, as well as our aging, population, 10,000 a day are retiring. And so I think all of these themes are going to hit at the same time. And we're just going to have an abundance of inventory, as well as, of course, the people in these oversaturated markets for Airbnb who realize they can't make it. And I know very sophisticated investors that are in this spot right now, multiple properties, having to list them and they're not moving because, they have some other obligation because of these increased costs. So I absolutely believe that we're going to have this. The inventory has already started, especially in Florida. You can see it coming on and it's gradually, then suddenly. And I think there are a lot of places in Florida, like Fort Lauderdale is a big one, that things are about, you can feel it, things are about to happen there. And I think they'll happen pretty quickly, as you know, because it takes one desperate seller, as you know, guys, that essentially when you finally decide that you're going to make your neighbor mad, you're okay with that, you're going to go quick and you know, you're going to get it sold and get out of the neighborhood more than likely. But you're going to make that choice because you have to. And I think a lot of people are going to be talking about that as they're preparing the Christmas meal, to be honest. And I think, you know, come January 1st, we're going to see even more increases in inventory.
You know, I talk to sellers. I have a couple listings that are getting ready to hit the market, and you know, just me personally. And some of them have stepped up their timing. My one seller, I mean, they want to sell as quick as possible. You know, the situation is, you know, as you're listening to these sellers talk about the market, they're waiting for these prices to drop. So I agree with you. I think the Airbnb market, there are a lot of people that are struggling right now. They had no idea that the costs were going to be where they are to operate. They're getting whacked by taxes. They're having the government shut them down. HOAs shut them down. And we had an influx of these. That's run its course, in my opinion. I'm not saying that Airbnb's dead by far, but I'm saying in a lot of the neighborhoods where, you know, mom and pop, you know, people thought it'd be a great idea to own a second house. They were able to get cheap money with their HELOC, their home equity line of credit. Now they're maxed out on that. They're paying higher payments than they should have, you know, or they expected, right? Nobody was expecting rates to skyrocket the fastest that they ever have in history.
Right.
Jay Powell's the first one to do this. He's the first one to raise the rates as high as they have gone in the fastest, shortest time period in history. Now, people that, you know, took out HELOCs, maybe they had $300,000 home equity, $400,000. They took a second mortgage on their house, essentially, with a home equity line of credit. They took that money and they bought that second house, that Airbnb or that rental, right? And now all of a sudden they're getting whacked. The rates doubled, almost tripled, right, on their home equity line of credit. Now you have the highest, you know, tax increases in non-owner occupied housing. They're not protected by homestead credit, where it only goes up so much a year. A phased in new, value phase in that doesn't apply to second homes. These people that have bought them for Airbnb and investments, they're getting whacked by high property taxes. They're getting crushed by, you know, insurance rates. Everything's gone up on the maintenance side of things. So these people are sitting on the sidelines saying, as soon as rates drop, that's my ticket, because I know they think they know that they're going to be able to get even higher prices for their property, but everyone's going to sell at the same time. So
That's
all
right.
of these people are going to hit the spring market at the same time. They're all going to be dumping their Airbnbs at the same time. They're all going to be getting out of their long-term rentals, a lot of them.
Their long-term
because
rentals. That's right.
They're getting whacked. They're getting whacked, right?
They can't rent them. They can't rent them.
You can't rent them, and the tenants are being weaponized against the landlord, right? New tenant laws. You can't evict. You can't do this. They're going to be moving out, and then there's the sellers, right,
Yep.
that have been holding on to the golden handcuffs of 3% and 4% mortgages. When that hits 5.5%, they're all going to hit the market and sell because they've been waiting. The only wake-up call, in my opinion, are going to be the buyers that are going, yeah, but I'm still not paying that price.
That's right. Yeah, they're going to negotiate the crud out of everything. I mean, and so I think it's going to be a standoff. And I think the buyers, they're going to take their revenge because they're mad. You know, they're really mad about what
They're
happened.
just waking up.
Yeah.
They're just waking up. I mean, come on. I mean, the activity that we watched happen for, you know, a year and a half, 2 years, it got so insane.
It's insane. Yeah.
Yeah. Let's answer some questions.
And it's hard to explain, to people how insane it was. I mean, people weren't sleeping, eating. It was nuts.
We're going to take some of the super chats here. Got respectfully, smart money is a title that should be buried. Smart money destroyed this market. As rates drop, the qualified person is still way priced out. Here comes more fake success, more debt, and more dreams put to sleep.
Yeah, well, we appreciate your super chat. And yeah, I mean, when I say the term smart money, I'm talking about the people that have money that are sitting on the sidelines right now saying, I'm not paying this price for these houses. And then you have the flip side. You've got the bulls in the market that are all saying, well, you're making a big mistake. Well, I guess the people with the money can afford to sit on the sideline. Maybe that they haven't made mistakes is why they have money. I mean, maybe because they've been a little bit more bearish is because they have an actual savings account. Maybe because they've been a little bearish and haven't jumped into, what has strapped so many people to a overburdened home bill, overburdening home, cost that people can't, they're in debt up to their eyeballs because all of their repairs are going on their high interest credit cards. By the way, the banks are kicking their teeth in. I mean, if you have credit card debt, you're getting crushed. Even if you have good credit, unless you've transferred the balances and taken advantage of some kind of a 12-month deal, they're charging you the highest credit card interest rates we've ever seen. On average, the highest is ridiculous.
Got another super chat here. Rates were set aside for so long that people believe low that rates are more important than price. You are the sound of reason, Todd. Unfortunately, it's an unreasonable market. The Fed failed.
Yeah, and I mean, thanks again for Kyle, your second super chat. We appreciate you, but yes, you're right. I mean, when you look at the rates, it's because America has been indoctrinated to what does it cost me every single month. That's what it really matters. It doesn't matter what the cost of the product is, only what's it going to cost me on a monthly basis. The problem with this mentality is you will always be in debt.
That's right.
So when you're thinking about what is this going to cost me monthly, you are trapped. You are owned by the banks, essentially. I mean, look, our forefathers have said it. You don't want to be owned by, the bank. They rule the roost. I mean, what we should be doing is thinking about how can we be debt free? How can we, and I'm not trying to be like Dave Ramsey here, but a lot of people want to give Dave Ramsey, a hard way to go. I don't agree when he says that the housing market will never comes down, because that's not true. It has dropped in prices throughout history. There's been time periods of price declines. But what I do agree with him is that we shouldn't be in debt. We shouldn't buy things that we can't afford to pay for. And, we started with our automobile, right? I mean, now we're financing the car for 7 years. How asinine is that? The car loses value the minute you drive it off the lot, except for the time when we couldn't get cars. And that, however, that was, that's another story. But when we saw that you could sell your car for just about what you paid for it 3 years later, if you think that's normal, the only reason that we had the mortgage interest rates that we've had in the last 10 years is because the Fed started buying mortgage-backed securities because no one would be buying houses otherwise. The only way that they could keep the market going up, because there's no reverse gear, right? We've learned that from our video with Brent Johnson, who wrote the dollar milkshake theory. It's a cool video. You guys can check it out on our channel. We just released it a couple weeks ago. But there is no reverse gear in our economy. We can't have a recession. We can't have a going back, at least to what the Fed expects in keeping our economy moving forward, is to continue kicking it down the road, and continuing debt, continuing devaluing the dollar by printing money, and making us more in debt in the process. So, Melody, take it over.
You're fired up tonight, Todd.
Take it over, man. I'm telling you, I'm as frustrated as everybody else, I guess.
Yeah. I mean, no, I echo your sentiments. I mean, this is just completely bananas. And it's, it's funny because as it was happening, I was questioning people in the industry. And, at the time, I think everybody was just in a crazy euphoria. And they just, they really believed that this was somehow justified. I just couldn't understand it. But I said something I said something today on Twitter, and I said, that essentially this Airbnb bug, for instance, is going to be way more deadly than COVID, because I mean, this mania, I don't think anyone actually realizes how big this is. It is just so pervasive. And what I've been seeing since I've been tracking, all of these listings, et cetera, for sale, rent, and for short-term rental, is that it's still going up. I mean, people are still trying to get in on this grift, and it's over and they don't know it. And I mean, it's wild because, I feel like there's stories all over the place, but people are still in the mania, Todd. I mean, that's the thing. We still haven't exited completely from that. So,
Melody, one of the things that you and I know going through the crisis, right? And I think people forget very quickly. We want to forget. It's like, and I've said it before, it's like a hangover. You get up the next day and you're like, oh man, I'm never going to drink again, right? And then you feel better. And then you forget what it was like,
right.
When you're on the side of the road, right? I mean, you forget. You forget the pain. You forget laying there going, oh man, I feel the worst. I feel like we forget. And some of it's good that we forget, but it can be bad when we forget sometimes. And when we look at how quick the tables can turn, right? We look at, hey, everything's going great today. Boom, next thing you know, you hear Silicon Valley Bank's bust. What? We're in a bank run? What?
Right.
What's happening? Billions of dollars are being extracted from people are like in a panic because of their money. And then they put them in, like Chase and Bank of America, and they get billions of dollars. And then we hear things like, well, they're not doing that wonderful either, right? And we start hearing things about what's happening in the banking industry altogether. But you know what? We forgot about it already. I mean, that was on March 12th, the weekend. Now we're cruising right along. We're like saying, hey, the stock market rally, we got 500 points in a day. The Fed's going to drop the rates. Guys, everything is wonderful. We're moving full speed ahead. We're not even going to have a landing. Actually, the plane the wheels won't even touch the ground. We're going to cruise this thing right along, and boom, we're right back up in the air again, guys. And we're just going to continue on because everything is great. And then we hear in the backdrop, well, wait a minute. FHA needs to come out with a new bailout program, or millions of people are going to lose their homes because they still can't afford their payment. My question is this: who's going to replace their heating and air system in their house?
right.
Who's going to replace the roof? If they're not being able to pay their mortgage payment, there's no savings.
Right.
So we have one of two things happening. We have somebody in a house that the only reason that they're there is because they haven't really had to pay their mortgage payment. In their mind, they're either thinking, well, I'm going to ride this out as long as I can, and then I'm going to move out. Or are they thinking, well, that's great. I'm going to start saving my money so I can fix the roof. We watched what happened. When people couldn't pay their mortgage payment, what happened? Back in, oh, wait. What's that?
Well, they left.
What happened when they stopped paying their mortgage?
They walked away.
They walked away, or they certainly couldn't do upkeep, but a lot of them walked away.
Their house fell down around them.
Yep.
They didn't fix anything. Let me tell you something. There are people that didn't pay their mortgage for 10 years. Did that prevent the '08 crisis from happening?
No.
There were people that didn't pay their mortgage for 5 years.
There's people that still haven't paid their mortgage.
Yeah, but I'm talking about in '08, the '08 crisis.
No, I'm talking about from then. There are still people in New York that never paid their mortgage or haven't.
Still in the house.
Yeah, still in the house because of statute of limitations and other issues. So yeah, no, I mean, absolutely. it doesn't matter what government programs. And I think that, we focus a lot here as we're talking on mortgage, but I think those all cash sales were also leveraged. And I think that that's going to be a big surprise when there's all these homes that show up, at the county because you've got a tax lien sale. And everybody suddenly wonders, where did these things come from? Because they're not on a bank's balance sheet. And also something I've been diving into, Todd, is the private note sales. And I think that's going to be a big surprise to everybody because the delinquency there is much higher than what we're seeing in traditional mortgage. And so I think there's a lot of things that people just don't understand. But to your point, the crisis still occurred. We didn't help anybody. I mean, you go back and talk to those borrowers that had their lives hanging in a balance, not understanding whether they were going to be able to keep their houses or not. That was a terrible time because they didn't know for sure. And so it was just this constant threat hanging over their heads. I mean, it was horrible. And so on the other side of these, what they seem like, or at least people portray them as programs that are set out to help borrowers. I've on the other side. I've seen what happens to those people that were never able to afford their house, and the amount of stress that they had to live under, worrying day in and day out that somebody was going to come take their home. It crushed them. It crushed families. And so maybe you kept them in the home for longer, but you didn't save them because the stress, was too much. And so I don't know about you, but I haven't talked to a lot of people that came through that and got a modification and everything was great. There were so few of those people.
Yeah, well, I mean, and you're right. But the thing is like, how long can you bail people out for? So the ones that continue, if you need to continually bail someone out, the chances of them all of a sudden after 4 years or 5 years. I mean, come on, man. We're not talking about a lift up. We're not talking about, hey, you're down and out, you lost your job. We're going to lift you up for 6 months, get you back on your feet, dust you off a little bit, and point you in the right direction. And they say, hey, thanks a lot. You saved my life. You saved my house. You saved my family. That's wonderful. You gave me the reprieve. We're talking about people that have been struggling for 3 years, 4 years, 5 years.
5 years. 7 years.
I mean,
that's right.
Let's be honest here. Let's talk about this and say, hey, look, if we don't think that we've got a housing crisis or a housing affordability issue to where people can't have a home or afford a home, or you got to prevent them from being evicted for, years after it, we had a shutdown, of which during the shutdown was the biggest bailout we ever have. I don't even know how people could have been hurt. We gave the companies that laid them off money, to keep them on. We gave, unemployment. We gave a stimulus of like $700 federal stimulus for 6 or 7 weeks or whatever it was. I mean, we helped people get back to work. We implemented all kinds of programs. And, I don't understand how we couldn't have, what more could we have done to help people out, to helicopter money to people's doorsteps? So I don't understand at this point why we're not better off, because it doesn't work.
It doesn't work.
It doesn't work.
There's the thing is not being able to afford a home. And there's, quite honestly, had we not tried to push these folks into home ownership, because this was happening, Todd, before COVID, right? Like that FHA started doubling very quickly after 2009. And so, because the machine had to keep going. And essentially you can look back in history, you can look back at what the home, like historical home ownership rate is, and how the government always tried to get involved and push that higher. But in reality, every time they did, things always went south. Because there are just certain groups of, there's certain people that can't afford a home at that moment. Maybe they could in the future, but I think by pushing them into the home, we've probably sort of negated their ability to own a home in the future, because ultimately they will exit. You can go back and look at HAMP. You can look at how many people that actually helped, and it wasn't that many comparatively speaking. And so the same thing will happen here. And in a way, by pushing those people into a home too early, we're likely, reducing their chances of ever being able to own a home, in my opinion.
Absolutely.
And I think the other thing, oh, go ahead, Todd.
No, go ahead.
Well, I think the other thing we just can't forget, because I don't want it to make it seem like, these FHA borrowers who truly were trying to get in a home and do the right thing. But I think a lot of what's happening here is investor speculation. I think a lot of, even back before COVID, people were using FHA loans for short-term rental, long-term rental, and it's, non-owner occupancy fraud. But, they got away with it. And so I just think that there was rampant speculation that got started sort of in, 2012 to 2013, and then just went absolutely insane during the COVID boom. And so a lot of these homes, these struggling borrowers, they're actually investors and fraudsters.
Yeah, well, I want to pull this up, Joe. What do I got to do to pull this article up here, Joe? That's hang on a second here. We're going to do that. Let's answer a question while I get.
Yeah, we've got some more super chats here that I would like to address here. I was listening to a Patrick Bet-David podcast, and apparently Americans put thousands of dollars on buy now, pay later on top of credit card debt. Wait for that crash too.
Yeah,
right. And that's not even reported to credit. Like most of those companies don't report to credit. And so this is another whammy that's coming.
Yep.
All right,
Thank you, Charles.
I think I've done, I don't know whether I've done this or not here. Let's try it. Here we go.
Okay.
All right. Man, I tell you what, I'm so sophisticated. They call me Mr.
Please don't put this in front of me,
here.
Todd. I can't look at this, Todd. I can't.
Of course, I don't know how to move the article now. I don't know how to show it to you. But the thing I wanted to really kind of point out here is this just came out. Jeff Bezos-backed real estate company is launching a new fund to acquire more single-family homes across the U.S.
Yeah.
Does that make you want to throw up?
Yeah, it makes me really angry. I'd love to see the business plan, because if they're planning to buy now, then they're going to get in a lot of trouble. But they're planning to buy later, I'm going to be real mad. So,
here's the thing. I mean, and this is one of the issues that we have, that we became a country where we really sort of over the last decade. Now, real estate investing has been something that's been going on for forever, right? I mean, you have landlords that buy properties, and there aren't people. Not everybody can buy, and there was a good need for mom and pop landlords to have nice rentals that people could rent that otherwise couldn't buy, but they could still live in the neighborhoods and that they wanted to be in, and they could have a home with a yard and things like that. And so this has been a great practice, right? It wasn't until 2011, 2012, when we went through the crisis, when we bundled up all of these foreclosed homes and sold them for nickels on a dollar to Wall Street. And they sort of, got the taste of what it was like to go through 10 years of appreciation, price appreciation, rents higher than they've ever been. And so it really whet the appetite for people to think it was kind of sexy to go on Instagram and show how they're driving Lamborghinis because they have, 1,000 rental properties, and that a third of the home buyers in America have been institutional buyers for years and years and years. And then you see a guy like Jeff Bezos that is rich, man. I mean, redefines rich, right? I mean, we're talking about, Amazon, right? Who doesn't know who Amazon is? And now we see headlines, and this came out, by the way, in 2021, Arrived Homes, where it was fractional buying of homes, right? Invest it $100 and you can invest in a house. And now we got headlines here that says that, he's ramping up. Jeff Bezos-backed real estate company is launching a new fund to acquire more single-family homes. If that doesn't smack you in the mouth right about now, if you're a buyer that's sitting on the sidelines that's only hope to be able to afford a home, and then you see some, headline article like that, I mean, what a way to kind of make you mad.
It's upsetting.
I think how much Jeff Bezos is involved in a company, I don't know, but they're using his name.
Yeah.
So it doesn't make it look real good in my opinion, humble opinion.
Right. I think that article, the same day his yacht arrived in Miami, it came out. So
Yeah, I mean let's stoke the investor barrel here and see if we can't deplete more of the inventory away from potential homeowners and put it into the hands of people that are going to profit on our home. And look, I don't have a problem with people making money and profiting and things like that, but I think that there should be some kind of a
housing
limit
shouldn't
on
be a casino. Right.
what somebody can buy.
Yeah.
We have a question here for you, Melody. Melody,
Sure.
do you believe Jason Hartman is honest?
I don't know enough about him. I did the interview, which was edited. So I got to be honest. I don't know enough about him to answer that question. Sorry.
Okay, fair
And I
enough.
wonder if they ask you the same questions about me after
Gosh. Charles had another comment here. Charles, thanks so much for your super chat.
Thank
I'm
you,
one of
Charles.
those buyers that's waiting. Mortgage score almost 700. Money on the side. I'll probably waiting till 2025 to buy.
Sounds good.
Yeah.
Yep.
I mean, it's, we'll see what happens. I mean,
Yeah.
we're going to know it all probably in 12 months. I mean, come on.
I think
It's
so.
not going to take
Yeah.
long at this point. Right? Melody?
No. I mean, I think we're going to have a good idea by probably middle of this year, of 24. But I do, as you know, housing is the Titanic, and it just takes a long time to turn, but it sinks a lot faster.
We do have another, excuse me just one moment. We have another question for Melody. Melody, what is going on in Las Vegas with loans and home prices?
So Las Vegas is just absolutely delusional. I'm just very curious to see what happens after this Formula One debacle, because I think there were a lot of hopes riding on that. But what I saw there was just absolutely wild. I mean, the amount of rental inventory that was being built, at the kind of, we may have talked about this last time, but it was like, if you're familiar with Las Vegas, it was kind of down to the left of the canyon. And so that was for the serfs. That was all the build to rent. And then they were building, kind of up in the mountains, just these very expensive homes that were right next to each other, were not all that attractive. I just think it's gone nuts in Vegas. There's no infrastructure. And so these homes are being built, but you can barely get around in the city. So I just think it's delusional. And I'm seeing inventory there rise quite a bit for listings for sale, rent, and Airbnb. I think that Las Vegas is in for a real correction. And I think probably the delusion is going to be over here probably the next few months.
Melody, are we getting the true picture of, I know you do a lot of traveling. You just got back from Denver, right? I mean, what are we seeing? Are these home builders, are they reporting true inventory numbers?
Absolutely not. I mean, and so you can very easily, if you're looking for rent, for instance, and you see a whole build to rent subdivision, you'll see one card on realtor.com, Zillow, or whatever for that subdivision. And there's 200 more there, and the same for the new builds. And the builders also strategically kind of will list on one listing site versus not on the other. And what I was noticing, because, I look at listings and those numbers every week, but I was just recently noticing that we were having a little bit of drop down when we were having a lot of momentum forward. And I had someone run a scrape of Lennar listings, and I was just checking them. And many of them aren't on realtor.com, which is what the Fed uses. That's actually the source of the Fed's inventory numbers is realtor.com. But there were some of them on Zillow, not all of them. I was just kind of checking them. And so I think the builders are actually pulling listings for end of year, to be honest with you, because I think that some of them know that, if it's not officially completed, then they don't have to pay taxes on the home. They can just pay taxes on the land. So I think we're actually seeing inventory, even though they were already kind of slow rolling the inventory or not listing at all. I think they're starting to pull it now. And, I'm trying to prove that out. I'm working on that, but that's what it looks like.
Yeah. Yeah. Well, that has a lot to do with what people are thinking and feeling, because, if they keep saying the inventory is low and in fact it's not low, right. I mean, look, let's face it. We don't want the buyers to know just how bad it is, because then they would right. be more aggressive with their offers. Right. I think that buyers would then, think that they have a lot more strength than what they would have if you don't think that there's much inventory out there. So I think it is important that, what you're doing and going out and checking these neighborhoods and these numbers and, reporting on it. I think it's great. Hats off to you. Appreciate your boots on the ground.
Thank you.
Let's take some more questions.
Yeah, we've got some more questions for Melody, specifically talking about, we've got a few about Florida, actually. Melody, can you give us more details on what's happening with the real estate market in Fort Lauderdale that you mentioned earlier?
Yeah, there's just some crazy speculation in Fort Lauderdale. I don't know how many of you guys know about the flood that was last April, but it was like this crazy flash flood that came in, really damaged a ton of homes. And what happened is investors came in. And so a lot of people, instead of like fixing their homes, getting rid of the mold, they just sold to these investors. And then these, investors kind of put lipstick on a pig and said, okay, now I'm going to, sell it for 3 times as much. And, maybe I'll Airbnb that until I can sell it. Well, neither of those things are working out, because, there's one I actually visited. I shared this on Twitter. It's right next to a substation and a cemetery and 5 miles from the beach. And they thought they were going to get, an astronomical price. And they've started drastically reducing that price down now. I mean, they are desperate. And so in Fort Lauderdale, you just have a ton of inventory and a lot of speculation. And you've got investors or fraudsters coming under stress, and they're going to start slashing prices. And so you don't have really a lot of inventory moving there. Sales are down. To me, it is kind of it's a perfect location to watch to see how things are going to go across Florida, because there's many markets where I see a lot of inventory, but it's just sitting because no one has taken that first step. Think somewhere like Boca Raton, but pretty soon the desperation will hit and that first step will be taken. But Fort Lauderdale is in for a world of, when I was there, I just couldn't believe the speculation. In a whole neighborhood, there was hardly any people left. It was just all either, being flipped or kind of, in the process of being flipped or vacant. That was your options in what used to be middle-class neighborhoods where families lived. Fort Lauderdale is in for a lot of trouble. Plus that flooding that nobody's talking about. Like, they haven't fixed that. So, yeah.
Yeah, certainly aren't hearing it on mainstream media.
No.
Yeah,
I feel very lucky that I was there in person for a couple of months, because I really got a different sense of what was happening versus kind of not being in the state. So
these investors that bought the houses, after the flood, that thought that they would be able 5 miles from the beach, they probably had really good real estate agents that help sell the home to them. They probably told them that, everything you touch turns to gold, and just put lipstick on a pig and, charge 3 times the amount, and I'll be able to sell it for you. I wonder if the ones that sold it to them, that helped them buy it, are still around helping them to, sit on the market and have, price reductions after price reductions after price reductions, and watching, the money go out the window. I'm just kind of curious. And this is another reason why
they went back to their bartending job, Todd.
Yeah, exactly. This is one of the, when we say that it's important, even if you're an investor, to have a good real estate agent that can tell you what's happening on a local and a national market because it doesn't matter how much you spend. By the way, I mean, I hear all the time like, hey, it's worth this much money because I spent this much money. That's not how it works. Your house is only worth what somebody's willing to buy and pay for it. And we can see the demand is weak. We don't have, we have our commenters. I mean, plenty of people sitting on the sidelines with cash. They're just refusing to pay what the prices are today.
Definitely have some more super chats here. KOV 12, thank you again.
Yes, thank you.
I make 4 times more than my grandfather. He had a home, 9 kids, and 2 cars, and was at the dinner table at 5:30 every day. The American dream is over, yet people are still partying like the music won't stop.
Absolutely.
Yeah, and there is
dinner table at 5:30. I can remember when I was growing up, if I wasn't, we had dinner at 6, and if I wasn't sitting down at quarter of, I didn't eat. I had to come in and, my grandparents, I lived with my grandparents, and that's what happened. My grandfather believed that you respected your grandmother that spent 2 hours preparing dinner, and you didn't just come in whenever you wanted to, and you sat down at the table. That meant a lot. And we didn't have a whole lot, but we had plenty of love and, morals. My grandfather didn't believe in being in debt either. That's one thing for sure. He didn't even like to sign contracts. I can remember one time I was a kid. We used to get these door-to-door salespeople that would come to the house all the time. That was pretty common back then. That's how people sold things, like encyclopedias, when we didn't have the internet. And anyway, I can remember a guy wanting my grandfather to sign a contract, and my grandfather refused. He said, no, we shake hands around here. We don't sign contracts because that contract is to protect you, not me. And, that's what he believed in. So he was a handshake kind of guy and believed that you say no more than you say yes. You've heard me say that in sales meetings.
Oh, yeah.
Where you should be quicker to say no than yes because yes means yes. And
That's
so
right.
many of us nowadays, we say yes but don't mean it. And then we back out of it and don't follow through with what we're supposed to do. It's just some of the sentiments that, and morals and ethics that we had back in the day when, people worked hard and not that we don't work hard today, but valued the dollar. And these are people that went through the Great Depression, right? They knew what it was like. I mean, one day to go from the roaring 20s where everything was great to, a massive stock crash and, overnight almost, and then sink into a 10-year depression. Happened just like that. So, I mean, when we're cruising along thinking that everything's great, we've got a new video coming out, by the way. You guys are going to love it. You're going to think it's really interesting. I interviewed a guy by the name of David Tice. He is a movie producer, and he produced a documentary called Grid Down, Power Up. It's being released here in the next couple of days. I interviewed him. He's talking about, we kind of leaked out a little bit last week when we talked about not that long ago, a lot of people that are alive today that either have parents. So if you're my parents' age, they had parents that lived in houses without electricity. Also, most of the people alive here, their great-grandparents lived in a time period of where the house probably didn't have electricity. And we're talking about, here, he's pulling it up here, this documentary. But anyway, back in 1925, only about 40-50% of the houses had electricity in it. Not that long ago. It wasn't until the 1960s to where houses had running water, all houses just about had running water and electricity, what I'm trying to get at here is that we've become a society completely dependent on electricity. And the issue, what David is trying to bring awareness to, and, is the fact that our grid is very vulnerable. And he lives in Dallas, Texas, and in 2021 in February, their power grid went down. There's only 3 power grids in the U.S., ladies and gentlemen: the Eastern, the Western, and Texas. Texas grid supplies Texas. Well, they had a meltdown in the winter, in a winter storm, and within 3 days, their shelves were completely empty in their store, and the stores were empty. And we can only live about 3 days without running water, and a lot of the municipalities are dependent on electricity to have running water, and none of us prepare for anything like that. I'm not trying to go overboard and say that I'm this massive prepper or that everybody should be concerned. But my point is that we take so much for granted. And we think that things are cruising along, and they are, and everything is good until it isn't. And what we're trying to do here is say, look, not trying to scare people. We're just trying to say, look at the data, look at the facts, look at history, and realize that it wasn't that long ago, that we had a very simple life. Just like Kav just said in his comment, things, 9 kids, dinner table, 5:30, a lot of things, right? We've gotten so far away from, and now we're concerned about how much something costs on a monthly basis. We really should be concerned about how much money we have. We should really be concerned with, how we're being conservative and only buying what we can afford. What we really should be concerned about is, are we going to have our jobs? Because we think that we're, invincible, and we're not. We get out of whack, and life has a tendency to bring us back. But since we now have the government that extends the pain, and just kind of puts Band-Aids on things and kicks the can down the road, at least till they're out of office. Now all of a sudden we wake up and we go, geez, we're in more debt than we've ever been. We're so stressed out financially. So anyway, watch it this Saturday. It's going to be I'm telling you, it's a great video. It's a great interview. You guys are going to really be, you're going to go, wow, when you see this documentary.
Yeah. Kav has another. I'm just going to keep on going because Kav should honestly be a guest on our show because of these comments. They're so good. Right. As we listen and comment, marriages are falling apart, drug and alcohol abuse rise. Respectfully, it's too late for many to wait for 2025. It amazes me how we plow through those lives as we continue on.
Yeah, Kav, I'd love to know what you do for a living, man. You could comment that if you feel like sharing it. You have a lot of common sense here. Appreciate your comments. You're not really asking for a question to be answered. You're just kind of telling us, some, good fundamentals.
Yep.
Life fundamentals. So we appreciate that.
Definitely. We do have a question here, another super chat. Do you think the Fed diverting their asset inflation into people's houses and trapping them into low interest rate loans will slow churn price discovery?
Melody, you want to talk about that?
Well, yeah. So we were kind of talking about this a little bit for the show. Fannie Mae just did a survey and got some surprising results that basically kind of debunked how powerful the lock-in effect is. So I think right now, what's slowing price discovery is that it's frozen because people can't, they have to have a place to live. And if they sold right now, they wouldn't be able to afford a like home or it would be just like their home and they would have lost any concept of equity. And so I think that has already in some ways sort of slowed price discovery more because you have the buyer seller strike. But I think it on a go forward basis, as these rates get lower, and as we're seeing right now, I think as Todd was saying earlier, the sellers are going to come to market and we're going to start seeing that inventory and we will get true price discovery.
Yeah, I mean, they can't not come to the market. They're all sitting back waiting right now. So if you look at, and by the way, mainstream media is touting about this. They're proud of it for whatever reason. Hey, America's sitting on their homes because they're, have the lowest interest rates. I just interviewed Peter Schiff. He even said and this is crazy, but true in the mentality. They're like, what Peter said was, it's the interest rate is your asset right now. The interest rate is your asset. Now, what I don't agree with Peter, and I love Peter Schiff. I think he's I think he's a very knowledgeable person on a macroeconomic level, in understanding currency and monetary policy and, the dollar, and how it's being devalued. He's great with that, right? But what he said about the housing industry is this. He said people won't sell their houses because they have low interest rates. They'll just move and rent their house. And I disagree with that. Because a lot of people with this mentality they believe that people want to be landlords. that sucks for the majority of people. If you think landlording is easy, you're nuts. Okay? It's not easy. It's like one of the worst things in the world to do. First of all, you're now your tenants' problems are your problems. So you've just added people that you have to basically take care of in your life, right? Because you got to answer calls, you got to fix things. Some are needier than others. They may not pay their rent. They may destroy your house. You may realize that your golden handcuffs, the 3% interest, on your $600,000-$700,000 house, you're going to rent it to somebody who's going to destroy it, and it's going to cost you $150,000 to fix it, right? So that is the most ridiculous thing I hear people say is they're going to keep the house and they're just going to rent it out and move on. No, they're not. And not only are they not going to do that, they would not make money. So if you're talking about, a mortgage payment with taxes and insurance and everything else that goes along with the repairs, they're not going to be able to rent it for the amount of your monthly payment. So get that out of your minds. People are waiting to sell. That's what they're waiting to do. They're waiting for interest rates to come down, and as soon as they do, they are going to sell like you haven't seen. It's been years, guys. It has been years of low inventory. Do you think it's going to stay that way? Do you really believe what you hear, that we have a population incline? We have immigration coming into the country, but we have less people having babies today than we had 40 years ago. You just heard Kov say 9 kids. That's unheard of nowadays. You have people in their 30s and 40s that don't have kids, right? What we have is the largest population of one person living in a house that they don't need a house that big. We've got a population of 2 people living in a house that they don't need a house that big. They're waiting for the interest rates to drop, and when they do, the sellers are, in my opinion, they're going to flood the market. So we're going to see what we're talking about. And a lot of the people that are coming into the country aren't buying houses. So when we talk about, immigration pouring across the borders, things like that, a lot of these people, they're not getting loans. They're not buying houses. They may fill the rentals, but as far as home ownership, people buying the houses for sale, maybe that's why Bezos is planning to buy them all.
Well, with all that multifamily coming online and competing, Todd, then those people aren't going to be able to cover their costs, even if they tried to rent, because this multifamily is going to send rent down, as well as all the build to rent. And this is very difficult for people to track that build for rent because they don't break it out, or they kind of leave it out when you look at the census permit numbers. It's the extra stuff, and I'm actually building kind of a model on that right now. But the fact is, we have so much inventory coming online, they're not going to be able to do long-term rental. I hear from followers every day about I've heard this week several listing for sale because they couldn't get anybody to rent. So that's not going to be the option.
Melody, we're talking about rents dropping for the first time in history. We're talking about rents dropping, rental rates dropping the first time in history.
Right.
Now, here's the thing, right? There's a lot of investors out there that can't afford a rent drop, like all of them that bought in the last 3 years that said, hey, this is great. Don't stop buying. Buy, right? Here's the thing, right? When we're talking about, inventory, rental inventory hit the market. So apartment complexes, they don't want to drop rental rates. Okay. So here's the thing. I said interest rates because Charlton, we're going to answer this question or this comment here with his exclamation point. But here's the thing. Here's the way home builders handle price reductions. Well, we can't really drop the prices right now, guys, because everybody that just bought or is under contract to build, if we drop the prices, we're going to really upset them. We're going to get horrible reviews, right? We're going to drop the rates or prices. But here's what we'll do. We're going to add concessions. So what we're going to do is we're going to do rate buy downs, right? And we're going to do things like finished basements, or we're going to add all these niceties. And we're going to include that in the price. So instead of dropping the price, we're going to give you more for less money. And we'll build a little bit smaller house now. We'll pull in the footprint a little bit. We'll shave a little bit of cost here to make up for the extras that we're doing. And, and then we don't really talk about that a whole lot, and the rest of the neighborhood doesn't know about it, and everything's good and everything's fine. Well, apartment complexes do this. Well, I tell you what, we got a sign-on bonus for you guys. If you sign a new lease, we'll give you a 15-month lease for the price of 12. So we're not actually going to drop the rent price, but they're dropping the rent price because they're giving you 15 months instead of 12 months. So they're giving you 3 months for free, and that's the way that the apartment complexes deal with that. That's all well and good until that doesn't work.
Right.
And now, guess what?
Yep.
You start doing what you have to do to survive, and you don't worry about your other tenants, what they paid, or that are under contract lease, that you're not going to help them until the lease renewal is. Well, we'll deal with that in a year or 15 months or 18 months. And the home builders are getting in the same position because they're like, you know what are we going to do? I'll tell you what we'll do. The home builders come in and say, we'll sell scattered lots. So we'll let that home builder come in and build a cheaper house or a less expensive house, but we'll just sell the lot, and then they won't be mad at us because we're not the one that's building the house. We just let 3 other builders come into our subdivision and buy our lots. That's another thing that they do, right? But anyway, Todd says interest rates will drop. Here's what I believe. I believe that we're in an election cycle. Next year is going to be critical, right? They can't, the party that's in control right now can't let things fall apart. They have to keep things together because, there's 2 things that would destroy the current administration. One is high unemployment and a bad economy. So we've got to do everything that we can to not let either one of those things happen. It's my opinion, right? I believe that interest rates are on a cycle that's heading up. I think that mortgage interest rates are going to be in double digits, but it's not going to happen now. It's not going to happen yet. I think we're going to get a break. We're going to get a stimulus. We're going to get a break. And then we're going to see it go back up again, 2025. So I think that what a lot of people, look, they're not stupid. They're going to see we're not getting rid of debt. We're not all of a sudden going to have an increase in wage growth, 30, 40, 50%, 100% wage growth. That's not going to happen. We're seeing banks tightening. A commercial real estate market's about to collapse. We're seeing banks on the brink of, they need bailing out. So we see people can't afford to pay their mortgage. They need to have an extended modification. So we're going to do as much as we can. And what that's going to do is build more debt, hyperinflation, devaluing the dollar, money printing like we've never seen before, right? We know it's coming. Now what's going to happen is we're going to try and prop it up as much as we can, is my opinion anyway. I could be wrong, right? But I think we're going to prop it up as much as we can going into 2025. And 2025, a new president, if there is the new president, or whether Biden's, who knows? I don't have a crystal ball. But all of a sudden, whoever it is in 2025 is going to be like, ooh, man, we got a serious problem here that we kicked the can down the road. Just like Obama had when he dealt with the housing crash, right? So, that's what I think. Melody, anyway, Charlton, I just wanted to, I saw that comment pop up here a little bit that I do get to see and all these comments streaming through. But I don't want you to think that I believe that we're going to have 4% mortgage rates, because I don't think it's going to go that cheap. I think we'll probably be in the 5s to 6s for a short period of time. We're going to have, it's going to be just enough to stimulate sellers to hit the market, people to get out while they can. And then 2025 is going to come and we're going to face the music. Again, my opinion, who knows? Who am I? I'm just a real estate broker here in Maryland.
And Todd just said it, guys. These homes are only worth what we buyers are willing to pay. I know it's tough. I have been waiting to buy, but it's about damn time the buyers be in charge.
That's right.
And then we've got Travis saying, vote Todd Sachs 2024.
Travis. Yeah, vote
I
Todd
hope
Sachs.
Travis is surviving on the
Write
road.
me in the ballot, all right? Because that's what it would take. You'd have to write me in, right? I wouldn't want the job of president for nothing.
Yeah.
I might be a cook down at the local breakfast shop here, and who knows? We had we had one of the worst attended sales meetings ever. Was that today?
It was today.
Seems like so long
I
ago.
know.
I think everybody's, decided that they're whatever.
Doing things.
That's another, yeah.
I don't know. Let's not go there.
So, back in 2008, if you told people you were a real estate agent, they asked you what else you did. What else do you do? Guys, we do have an amazing broker network. If you guys are looking to buy, you're trying to prepare, you're trying to get yourself ready. We have, some great lenders that cover most of the country that could help qualify you and tell you what you need to do to get some of the best interest rates. We also have a great real estate broker network, agents. It's growing every single day. And so if you need an agent, you can reach out. If you don't find anybody on our website at sacsrealty.com, you can reach out to us and we can let you know if we have somebody that can help you out. Also, title company. We have one of the best title companies. Did a podcast with him. David Thurston owns a company called Crown Title. Just very knowledgeable. He's an attorney, and it's great to have an attorney-owned title company when you're trying to determine how you're going to title your house and making sure that you're covered. What things, the pitfalls that people go through when they buy a house. You think struggles of just buying a house and fighting for price. Guys, some of the craziness that we've seen with encroachments, people not knowing where their property lines are. I mean, this is just, when we talk about, there's so much deeper. There are so many issues that are deeper than just home price. The mistakes that we watch people make. People buying houses that people have sheds on their property, and now they got to fight with the neighbor to say, hey, your shed's on my property. And they're saying, well, it's been there forever, and now you bought the house, and that's the way it is. Or, it's insane. Or they buy the property, and the next door neighbor tells them that the pool house is half on their property, and they didn't want to deal with it with the last person because they were friends with them. But now that the new owner bought it, they want you to take down the pool house that you thought was yours, but it's on your neighbor's property. Driveways that you didn't realize people have easements and access to. I mean, there's just so much that goes into this, and people were so panicked. They did no research. They had no idea what they were buying. They bought, like I said earlier, they bought houses that they wouldn't have bought if there were 10 others to choose from, but they were just stuck in the fear of missing out that they bought it, and it's in a terrible location. I mean, it's horrible. You got tractor trailer trucks roaring by your house at 3 o'clock in the morning on the freeway, and you're going, man, it shakes your house. You're thinking, well, that was great. Well, we didn't really realize how awful it would be until we bought it and moved in. We thought that we would deal with it, but it was the last house. It was the only house that we could find. And now they're going to try and sell it, and nobody's going to want it unless it's half price. I mean, it's crazy, the decisions that people made pressured into it. And so, anyway, what else we got? We got some more.
Yeah, we got some more. We definitely have.
Melody, you never know what you're going to get here. You know what I mean? Come on with us.
Oh my gosh. All right, we've got Charles here. Charles asking another question. Charles, thank you so much. Are banks losing money with people having 3% interest rates on their homes?
Melody, you want to take that? You're from the mortgage world.
Yeah, it's not good. The idea, so we talk a lot about the banks, but I think a lot of people don't realize that they don't hold a lot of these mortgages anymore. And really it's, honestly, the GSEs own most of these mortgages. And so, but absolutely, if a bank has a 3% asset right now, that's not their ideal situation. That's not how they typically make money. They essentially need to, borrow cheap and then lend out at a higher rate. And that's the opposite of the situation right now. But
yeah. I mean, well, we know that, Wells Fargo, Bank of America, Chase, I mean, look, they are holding mortgages. So, I mean, these correspondent lenders, I mean, Wells Fargo is probably one of the biggest, right? That they own these mortgages at 3%. Or under 4%, a large percentage of them. Some of them, in last year, I think when I was looking at the numbers, 40% of their assets for the bank is in mortgage-backed securities. So, yes, is it hurting these banks when they have 3% mortgages and they have to borrow money at 5.5%? Because they're not making money. They have to make up for what they're losing on these 3% mortgages. So I think a lot of the mortgage holders, would be in a better position if they if they did foreclose and could sell the asset and get their money back. So yeah, I mean, the issue is that these are the big banks, right? So yeah, I mean, when you're talking about banks that are only interested in servicing the loan and selling it on a secondary market, then absolutely, they're probably in a lot better shape as long as they're not dealing with mortgage buybacks. Because right now we're seeing where a lot of these lenders are buying some of these mortgages back because, the investors felt that they were underwritten very poorly. And let's face it, I mean, of course, FHA, I mean, like I said earlier, that's sort of like the subprime market because you don't have to have the highest credit scores, that you would need for conventional. You don't have to have as much money down in a lot of cases. And, there's a lot of programs that are out there. We just had somebody here in Baltimore. We got vacants to value grant money, $10,000. We just had a buyer could get for buying a house. So, I mean, there's a lot of programs that are out there for certain income brackets. And, but these banks,
yeah,
they're
I do want to make
definitely
a
losing money.
distinction, Todd, though, because mortgage-backed security is not owning the loan, right? And so that is an underlying security of the securitization trust. And so in actuality, the GSEs have these loans on their balance sheet and they sell those mortgage-backed securities. So those are a little bit different. And
But
so
aren't they invested in those at 3%?
They absolutely, but it's different than holding the loan on your books. I just wanted to make that.
Right, but they're still invested at that 3%, right? I mean, their money is still buying these bonds.
Right, that's still an asset that doesn't have the value that they need.
Right.
For sure. Yeah.
Yeah. I mean, if I take my money and 40% of my money and I invest in 3% mortgage-backed securities and it costs me 5.5% now, I'm making less money on my investment than I can buying money. So you would hope that if you invest in something that you're getting paid a return. Well, now you're not getting paid a return. You're getting whacked. You're actually losing money on 40% of your investment, right?
Absolutely. And these mortgage-backed securities are used to pledge, in kind of the repo markets, et cetera. And so it's again kind of the same example of like you had $1, now you have basically 55 cents that you're able to pledge to get collateral, to get cash. And so absolutely, these are not good assets. They can't use them the way that they used to pledge against borrowing, to get more credit. And so they're definitely hurting 100%.
Yeah. Mm-hmm. You talk about getting 50 cents on a dollar, Melody, and you mentioned this. You have a massive amount of multifamily inventory coming on market, right?
Oh, yeah.
A lot of people don't realize you don't just go stick a shovel in the ground and build 200 units. This takes years to do for developing the land, getting the approvals, putting in the infrastructure, millions and millions of dollars in infrastructure, stormwater management, curbs and gutters, roads, right? Ingress, egress lanes coming into the community. All that has to get done before. So first you have to go through the development process. Then you have to do the pre-construction right before, all the, silt fencing and the stormwater management ponds and all that stuff, millions of dollars. And then they start building the structure, right? So now we have all this inventory coming on the market. A lot of these operators that are building this inventory raised money, to build this, right? So now they're needing capital calls. So now they're stuck. They've got these buildings under construction or completed, and maybe they have rents, coming in, some rents coming in, some are vacant, or worse yet, you've got all these operators that raised money to make money and take a B or C class property, a lower class property, and make it an A class or improve it to get higher rents. So they're buying future cash flows. A lot of these companies now, these operators are having capital calls with people saying, hey, we need more money. We now, instead of paying you dividends on your money, we need you to put more money in, because if you don't, we're going to need to sell for 30 and 40 cents on a dollar. Right. I mean, you see a lot of this happening right now. It's
absolutely.
definitely Yeah.
I think multifamily is going to absolutely overtake office as the biggest issue. I mean, it's going to be a bloodbath out there because you had so many people get involved that had never done this before. They became syndicators and they're just falling apart right now. I mean,
Yeah.
it's just the things I'm hearing are just unbelievable. And the capital calls, they can't get it. And you know, these multifamily, when I was on the road, and this was in February, so almost a year now, I would see huge multifamily complexes complete and completely empty. And nobody was talking about it. And so, I mean, you know, and they'd be out in the excerpts somewhere, very much like Evergrande style, you know, in China. And so, yeah, this is going to be it's starting out as the quiet killer, but I think pretty soon we're all going to be talking about multifamily.
Yeah. All right.
I'm going to, Cov, thank you so much.
Oh, Cov. Appreciate you.
People used to know the worth of what they bought. That no longer exists. The Fed left the cookie jar open too long, and everyone, including the banks, have an upset stomach. Todd Travis ticket for real estate. You're doing a great job. Don't stop. Thank you for the very
Thank you so
generous
much.
super chat.
Yeah, definitely appreciate the comment.
Yep.
You know, look, I get comments on both sides of the, really the aisle, from the Bulls and the Bears, people saying they disagree with what I'm saying. And I'm not trying to be right? Melody's not trying to be right. We're just reporting what we feel, what we see, what our experience tells us. And, looking at the data, I mean, this isn't, look, it doesn't do me any good to tell people don't buy a house. I'm in the industry to make money off of home sales. I mean, look, it's not, there's still people that are buying houses. I still have buyers right now looking for houses, and I have sellers that want to sell. But the bottom line is that we have to be, transparent with the market, and we always should be. And, all we're trying to do is report the data here and say that this is just not a healthy market. What we've seen is not normal. It's not a healthy market. And, that's where we are. So we thank you.
And more than anything, we're trying to keep people from making a decision that they'll regret. And we're just trying to provide the education and information, not telling them what to do, at least. And so I it's so funny. In the last couple of weeks, the I'm a doomer accusations have kind of gone on steroids. And I think that really is telling that we probably are at an inflection point, because it's not that I'm trying to rain on anyone's parade. It's that I'm trying to arm them with all of the information so they can make the best decision, whatever that decision may be.
It's interesting. And along that line, let's pull up this article real quick. This is, Housing Market Outlook. So this is a newer article. This is important to say because, look, you can say doomer, you can call it whatever you want, alarmist, or you could say, you're practical in your thoughts and you're looking at the data. I mean, when we see the FHA needs to reduce mortgage payments up to 5 years, I mean, come on, man. I mean, if you can't look at that and say, well, there must be some kind of issues or we wouldn't have that. But look here, Housing Market Outlook for 2024, guys. This is December 2nd. Here's the good news and the bad news. Now, you have to read these articles and take them kind of with a grain of salt because they fluctuate. One day they're saying that home prices are only going to go up, and then this article tells you that home prices are expected to go down. Home prices will drop, but the decline in mortgage rates will be limited. This is on Insider today. All right, so we can go on to read this article. And basically what we want to point out here, it says borrowing costs will fall somewhat as easing labor and inflation data prompt the Federal Reserve to turn dovish. That's after 30-year mortgage rate soared this year, briefly breaching 8% in October. 8% is nothing. But while some see a drop to as low as 5%, Realtor.com sees the average of 6.8% because they know, I don't know, compared to the 7.22 in Freddie Mac's latest survey. Still, this will be enough to take pressure off of buyers. First of all, buyers Thanks, Business Insider, but the pressure's been off the buyers. All right. But this, ladies and gentlemen, now it's official. This will be enough to take the pressure off the buyers who won't feel rushed. That's laughable. Who won't feel rushed to buy before rates rise further. Demand should slow with home prices dropping 1.7%. Whoa. Okay. First of all, we've seen more of a decline than 1.7%. Now, a lot of markets. Let's go back to that article, Joe, because we want to keep going. I want to just finish this up. Here we go. All right. But the market supply scarcity will only get worse.
Oh.
Because when interest rates drop, people aren't going to sell. All right. The limited decline in mortgage rates is particularly to blame, as next year we'll still see rates exceed around 85% of current mortgages. Well, what do you think of that, Melody?
So not this article, but a similar one in Bloomberg today. And basically, I just said, let's stop trying to read the chicken bones. I mean, it's just almost comical, some of these articles. I think Redfin's saying maybe a 1% drop next year. Like these guys, I can tell you absolutely have no idea what rates are going to do. And they've never been right. If take any of them from the industry, go back and look at their track record. They have always been wrong and wrong in a big way. And so please keep that in mind.
Well, here's the bottom line. If they came out and said that home prices are going to be 25% less next year, what would that do to the market right now?
Well, I think it would probably bring a lot of people out of the woodwork is what it would probably do.
I mean, it certainly is less, problematic to just tell people expect a 1.7% decrease in home prices. Because then you're thinking, well, that's not that big a deal. I could just buy now. I mean, they must think that people are just
stupid.
Idiots, right?
Yeah.
Exactly. It's crazy.
Melody, I have a question for you here.
Sure.
Melody, you mentioned you were on a road trip and saw a brand new multifamily empty. Where was this? City,
So
state? So good.
Yeah, that one was Nashville. I'd have to go back and look at the zip. I can't tell you. It was an exurb outside of Nashville where, there was this strip mall that would probably house about 30 businesses that had one rented. There was a lot of coming soon of gas stations and grocery stores, but I don't have the zip code offhand. But that was Nashville. There's a lot of, and other places that you should go. Actually, Charlotte, south of Charlotte, Fort Mill. They have multifamily farms, like entire farms have been bought up, and it's just rows and rows and rows of multifamily. And so that's Fort Mill specifically. Check that out. And South Carolina, that's just south of Charlotte.
Melly, what do you think is going to happen in Nashville? Do you think it's possible that Nashville will crash, or is just going to keep on booming?
It's definitely not going to keep on booming, and it's already started slowing. Sales are coming down. Air traffic to BNA is down. The boom is over, and I think the biggest sign of that is that CNBC put out an article about it.
Yeah. Well, here's the thing I want to show you right now, because this is if I can figure out how to do it. Here we go. Thanks, Joe, for saving me there. I know I'm really good at this tech stuff, but here you go. Nashville real estate boom has builders scrambling and residents facing sky-high prices. And this is, what's the date on
2
this?
years
November
ago.
30th.
Yeah.
No, this is November 30th, 2023.
No, I know that, but I understand. They're just catching up. This is
Look at this. The Nashville building boom is in full effect.
Right.
Housing has become less and less affordable. I can't scroll up there, Joe. What? You can't do it? No. Okay. I don't know. Maybe this will work. There we go. All right. While the music industry has always called Nashville home, other sectors are moving in and buying up commercial space. I mean, look at this. This article is saying that high rises and high prices, housing demand in Nashville pulled back some during the first years of COVID-19 pandemic, but the city ranked in the top 10 for home buyers looking to relocate to a new metro area in October, with people most commonly moving in from Los Angeles, according to a recent report from Redfin, a national real estate brokerage. Really, you've never heard of them. It's not just economics. It's our climate here. It's our 4 distinct seasons. It's our culture here. It's our location. I mean, we're within 500 miles of about 2/3 of the population. Wow. That's amazing. Such a special place. Now, how do I get it down? There we go. Thanks. So what do you think? Nashville only going up?
No, Nashville has a correction in its future. I mean, you can't just build bridesmaid Airbnbs and all over downtown, and it's just not sustainable. And that boom got started early. It got started before COVID, and so I think watching Nashville actually, like Florida, and what's funny is my cities in Tennessee are increasing inventory at almost the same speed as Florida, which is a little fascinating. I don't think that I would have expected that. And in fact, in Knoxville, Tennessee, which, many people think is very desirable, especially because of the taxes here, they had the highest increase in foreclosures month over month. Not the highest, but they were in the top 10. So one of the highest. And so I think that we're going to see trouble here in Tennessee as well.
Yeah.
And Nashville has a reckoning for sure.
Yeah.
They also had negative demographics. I don't know if you know that, but people started moving out last year.
Moving out of Nashville?
That's correct.
Wow. What was the cause of that?
Well, so some of them moved to other counties, like outlying counties in Tennessee, but a lot of them moved out. And so again, we have such lag data. It's really difficult, these narratives of, there's hundreds of people moving here every day may be true until they're not. And nobody really knows when that is, because we have to wait 2 years to really find out from the census.
Yeah, crazy.
Can I ask a question?
Sure.
Okay, on the flip side of that, Melody, we get another question here. Let me have it pop up. What cities are most insulated across the country?
Yeah, so I guess, although I can't clarify with you, Sloan, I would clarify what you mean by insulated. I think that there really is no city that's not that's going to be completely safe. Even in these cities that didn't go crazy with these double-digit price increases, they still have these new build sites, like in Pittsburgh, just pockets of them. But there's not the demographics to support it. So I think, and even places like Cleveland that people talk about, oh my gosh, you can still get a deal there. And you can, when you go look at these homes on the listing sites, but their delinquency is rising very quickly, much more quickly than some places. And, their inventory is rising. So I think that this is going to be a national story. I think there will be areas that will be better than some, and it really would be those areas that didn't do the double-digit price increases, I would say. And that's mostly the Midwest, places like Ohio.
Gotcha. Well, you said that, because I've heard that, Ohio, and that their affordability's not what people were talking about.
Yeah, so their affordability looks okay, but the problem is apparently there's not enough jobs to sustain it, because their delinquency is rising and their foreclosures are rising. And so I think that's the other thing people forget. It's like, if we were all living in a work from home, fully work from home society, then yes, we could choose where we want to live. But the reality is yes, we'll still have work from home for some, but a lot of it won't be. And if you aren't living somewhere where you can find a job, then that housing market is not going to have a bright future either. And that's Cleveland. I mean, that's Ohio.
Yeah.
That's here where I am, Johnson City, Tennessee. There is no industry. There are no jobs. The median income is 45,000. And you can see it here in Johnson City. The investors are fleeing. You can tell by what's on the listing sites. It's like those Class B or C apartments, Todd, you were talking about. You see a lot of that for sale here. And then you see a lot of what we're, in the middle of a fix and flip. And then the new builds. That's what's on, inventory for sale here in Johnson City, because the investors realize it's time to go.
Interesting. I was thinking earlier today, Melissa's queuing up some more questions, but I was thinking earlier today about when I was buying houses back in 2008, 2009. And then I was thinking about, what I sold those houses for. So I was buying houses to flip, and, and we weren't doing lipstick on the pig. We were doing massive renovations. But I remember I was buying houses for literally $50,000 and $60,000 and $85,000. And I was thinking today, we sold those houses completely remodeled. And a lot of times, I should pull up photos in one of these podcasts of some of the projects. I mean, I think I have in the past, but I mean, I was taking houses and tearing them down and basically to their foundation, leaving one wall up, and, building a new house around it. And we were still selling those houses for $279,000 back in 08, 09, which is a bargain. I mean, it was still very affordable houses. And I was looking at some of them on, the MLS that have sold for $450,000, $500,000, that back 4 or 5 years ago that I sold for $250,000. But that's not my point. My point is I was thinking, what would a $50,000 house look like today? So when I'm looking in those same areas in Baltimore County on the east side, primarily I'm talking about Middle River, Dundalk, Essex, in the areas where we did a lot of the, we were catering to really a first-time buyer. And that's where I did a lot of the rehabs. And then Baltimore, a place called Hamden, which was a really hot area in the city. But I was thinking, what would those places look like today? Like if we had the housing crash that we had back in 08 of equivalent nature, what would they be? So I'm looking at some of this distressed inventory on the east side, the same areas that I bought a house for $50,000 to tear down, and it's $269,000 now. I'm like, that house I would have bought for $50,000 and tore it down. So I'm like, at what point does that, what do you say to people? Because it was at $329 and now they've dropped the price and they're at $279. I'm going, that still ain't nowhere near enough for an investor to come in there to take this completely distressed, outdated, crappy house and turn it into something that they could sell or even have a retail buyer wanting to buy it. I'm like, what are these people thinking? So, and seeing the market softening here, I'm still looking at it from a practical standpoint going, that is so overpriced compared to, as the contractor and me, what it would take for me to go in there and crash through the walls, rewire the house because it has aluminum wiring, make it safe, bring it up to code, put a new kitchen and 3 new bathrooms in it. It's crazy. Anyway, I don't know where I was going with that other than I was just looking back at the market going, this is how far we've come in 5 years, 7 years, to the point of,
It's
just
really
doesn't
quite
make
striking.
sense.
Yeah.
Doesn't make sense. Anyway, I know you have a lot of questions that we want to try and get through. We want to try and at least, get through.
Definitely want to just address some of these super chats. Some of them are just a super chat, and we're so thankful for all of you guys. Really appreciate you guys speaking the truth, even though it goes against your personal interests. Got Patrick Slane here, just giving some cash to say hello. Thank you so much, Patrick. Everything Melody has been saying about the tricks home builders are using is happening with Dream Finders homes in Jacksonville.
Thanks,
So wanted to
Carissa.
thank you guys for those. We got Cov here again. People are looking for honest. Right is subjective. Your honesty is priceless.
Thank you.
And then we've got another one from Charles here. Do you think the Fed knows they messed up and are trying to force foreclosures on 3% mortgages? So what you're saying is move to Tennessee from California in 2025?
Melody,
No.
you think the Fed knows they messed up?
Yeah, to me, I just at this point I'm more focused on the path ahead and do they know if they messed up or not? I think Jerome Powell absolutely knows that he made some bad calls when they called inflation transitory. And so I do think they're trying to cause some sort of correction. That is for sure. And I think we might get one. But go ahead, Todd. Looks like you wanted to say something.
No, I was just going to say it was interesting to me. I think Jerome Powell testified to Congress that the banking sector was strong and there was no indication that the banking sector was struggling. And then I think it was weeks later, Silicon Valley Bank collapsed. And so I'm thinking to myself, like, I mean, am I right in that? Didn't he testify to Congress?
Yeah, yes. And this is historically, they get up there and say that everything's fine right when everything falls apart.
Here's the thing. When you're running something, you're running the Federal Reserve. You're the chairman, right, of central bank. How do you not know what's happening in the banking industry? I mean, I'm just kind of curious. Like, I would think I try and put myself in the position and say, well, what would I think? What would I do? Like, what I'd have to be sitting there like, not wait to get out. I got to get out of this job. I would be thinking to myself, when do I retire? What's my retirement? I could not wait to get out of here. I mean, I would be looking at things. I'd be mortified. At looking at, I mean, you're talking about, you look at, Ben Bernanke, right? And when he said that the banks were fine leading up to the '08 crisis, and he said the housing market was strong. It could never collapse. It's never happened before. Of course not. I mean, you look at it and you go, man, these are some huge, big mistakes in history, right? And I'm not saying that you can blame Powell. It's not Powell's 100% responsibility and fault. You can't put that blame on one person or one, entity that they have that kind of power. But somewhere, this whole thing stinks. And I mean, it is what it is that we've gotten to where we are. The bottom line is, how do we fix it? What's the answer?
Absolutely.
How do we fix it? Can it be fixed? What's the bigger plan here? Because I don't think that we can get a straight answer. What is the plan?
No, I mean, a lot of it seems to be theater, right? I mean, we're gonna basically keep rates higher for longer, but we're gonna come up with government programs to ensure that people stay in their homes for the next 5 years, whether or not they can afford it. And so there seems to be a lot of performance going on. And that's really my point about managing the message. And that's kind of that's all they can do at the moment, because I think the train has left the station.
We could probably start with controlling spending.
Right. Right.
I mean, that would probably be a very good place to start.
Right.
I mean, looking at how things are being done, I said years and years and years ago, and look, I'm just an entrepreneur that's worked hard every day of my life. I mean, I've been working since I was 12 years old. I mean, I had to, right? Worked on a farm, baled hay, straw. I mean, physical labor, dug holes, built things. Just worked hard, right? I'm not the smartest guy out there, but I do know that you can't spend more than you make. this is common sense, right? I said a long time ago, we should outsource more things that are being done in the government. We should outsource these things and take it to the private sector, make it more competitive. I can remember going to get building permits, going to Baltimore City, going to Baltimore County to get building permits. I mean, watching the way that people work, at the counter was like unbelievable, right? How long it takes to actually get something done, right? I mean, if I were in charge, I would be looking at every single department in the federal, the state, the local governments. I would start putting incentive programs for them to save money, not spend money. We already know that they set these budgets up and they have to spend all the money in the budget, because if they don't, it gets cut next year. There's no incentive to cut costs to save money. Start putting incentives on these department heads saying, look, we're going to incentivize this department to save money. We're going to look at the roads and determine whether they really need to be dug up or whether we can live with a couple potholes. Right? I mean, I'm just, like I said, just a real estate broker here in Maryland, but I look at this and I'm like, at what point do we start to get control over the spending and start to shrink this budget and just let some fallout happen? Just let it happen. We'll deal with it, but let's let this correction take a hold.
Let's find some capitalism.
Yeah,
Please.
I mean, it's crazy.
Yeah.
It's crazy. I mean, we're weaving through this, trying to determine what the next interest rate's going to be and what the home prices should be. Whereas we got such bigger issues that it's crazy. Yeah, I mean, I've never seen it like this before.
A nice comment here for you, Melody. I've never heard of Melody, but her insight and knowledge is very valuable, and I'm thankful that she's sharing her experience.
Melody Wright's in the show notes. All you have to do is click on the details of this video. You can go over to her YouTube channel and subscribe to her. And she's definitely smart. She brings a wealth of knowledge to the industry, and we're glad to have her on the show. Have a couple videos you could check out. Just go to our channel and search for Melody, and you can watch some of her previous shows. Appreciate you being on here, Melody.
Well, I'm very thankful you invited me.
Last time your battery died.
Yeah.
You disappeared.
I did. I disappeared.
You stuck me with it.
I know.
You got to say what you wanted, and
I know you had to wrap it up.
Deal with the repercussions.
That's right. I know. It's terrible. Terrible guest.
Yeah. But Todd, I do want to, I'm going to have you address this comment here. Last year, Todd, you said by Q1 2023, we would see price crashes. You keep extending your prediction now to next year.
No, I'm not extending my prediction. Back in April of 2022, I said that we'd have a 10% price correction, which we had last year. I mean, you see a lot of the markets, we've seen price corrections. People define, so first of all, before the market turned in April, we were still seeing over appraised price escalation clauses, right? People paying over appraised value in cash for houses. This was just in April of 2022. We looked at the data. I said, this is all coming to an end. And it did. By June, July, they were done. We had seen the peak of the market. We had no more. We weren't seeing over appraised price escalations where people were willing to pay over price. We saw interest rates shoot up higher than they ever have. And we watched the biggest market slowdown that we've seen since the great financial crisis. Already, we have seen massive price correction. We are now looking at mainstream media finally admitting it. So what I'm saying is that it's going to continue. My expectation is that this decline that we've seen, the slowdown in demand, the sales crash that we experienced, and the buyers refusing to pay the prices that the sellers are asking right now is a slowdown in the economy. If you can't compare that to April of 2022 and say that we, in fact, have crashed to a degree, in the housing market, we went to a peak in 2022. around, depending on where you are in the country, in June, July, it showed up. We're now looking at new home prices have come down 15% year over year just in October reporting alone, right? This is on mainstream media. You can search that. You got to search for it. They're not broadcasting it all over the place. But with all due respect, we have seen exactly what we were expecting, what I was expecting back in April of 2022 is when I started talking, when the prices were still, we had yet hit the peak. 2 months later, we hit it. 3 months later, we hit it. Look, I'm not trying to be the expert that knows, I don't have a crystal ball, but I can tell you that we are in a different market than we are today than we were back in 2022. Thank God, because the pressure on the buyers was like anything else that we've seen. You knew there was an open house, ladies and gentlemen, because there was a traffic jam. It was the most ridiculous thing. I was actually in open houses, hosting open houses, where I felt physically uncomfortable and had to kick everybody out because it was so stuffy in there. You were bumping elbows with people. That's how many people were in the open houses. You don't see that right now. In fact, we're looking at houses that are incoming soon and that have just hit the market that don't have one showing scheduled for the next week, not one, right? We're seeing price reductions to the level of 45, 50% in some markets of home price corrections. Not just one, but again and again and again, these sellers are dropping their prices. Pre-2022, you didn't see that. You saw houses gone in hours and the prices were only going up week over week, day over day, month over month. You're not seeing that right now, right? So are we looking at massive correction already? 100%. You've got Jay Powell standing up in front of, his press conference after his meetings saying home price corrections need to happen. We need to see corrections in the home housing market, right? Not just once, he said it several times. So, I think it's fair to say that we're in a different place than we were in April of 2022.
Yeah, and I would just caution people too to question what is the data source, because something like Case-Shiller is repeat sales, that's not going to be your new builds where we were seeing those price concessions. And then as well for the new builds, they're not entering in all those price concessions, but essentially by paying your solar, giving you a new washer dryer, paying your HOA dues, that is a price reduction. And so mainstream narrative has been that it hasn't been as drastic, but that's on purpose. So question the data sources, question the narrative.
I was looking at a sale that occurred a couple months ago. Okay. The actual seller credit was $70,000 less than list price. There was a list price.
Yep.
There was a purchase price that was $70,000 less than that. And I'm sorry, it was $50,000 was seller credit on the settlement sheet. You're not seeing that as price reductions. You're looking at, okay, the seller took a $70,000 price cut to sell the house, and actually it was a $130,000 price cut.
That's
right? But you don't see the seller contributions on the tax record. So when you're looking at closed price, you're looking at a higher close price than what actually occurred because the seller credited the buyer back at the settlement table. So you're not seeing that, when we're looking at all the data. Seller credit, seller cashback. Let me tell you something. From mid-2020 to 2022, the spring of 2022, if you asked the seller for $1, you weren't getting the house. The sellers wouldn't even take FHA VA financing.
Right.
The majority of them. FHA almost went extinct in writing mortgages. You're looking at it now, it's only 16, 17%. You said it, Melody. The reason is because they weren't part of the buying process during the run to the top, right? Yeah. They weren't part of it. They weren't invited to the party because you had to pay cash. You had to have conventional. You had to have no inspections. You had to have no money down. You had to pay for the listing agent's commission. You had to pay all the transfer recordation fees. And you had to let the seller live in the house for 3 months with no rent back. That's what you had to do to buy a house. You can't compare that to now.
Right.
It's not, you can't even, it's not even comparison. It's terrible when people are saying that the housing market won't ever go down, and you just look at where we came from, and how could you honestly say that?
Right.
If we didn't see the massive cool off here, I don't know what else to call it. The question is now, what's going to happen going forward? And can however many, how many more millions of people need to be helped out so that they don't get foreclosed upon? And we want to say that the economy's strong. The housing market's never going to go down. These people can't afford their mortgage payments. A lot of these FHA buyers that are being bailed out, they paid a hell of a lot less for their house. They bought it before 2019, a lot of them, and they still can't afford their house. They still can't afford their mortgage payment. They've been refinanced. They have under 4% mortgage rates. They still can't afford their payments. Let me tell you what they can't afford. Their property taxes and their property insurance, for one. I was looking at a mortgage statement from somebody a week or so ago. They're like, look at this. Does this even look right? Their escrow amount was more than their principal mortgage payment.
Oh, yeah. Yep. I'm seeing that. Escrow notices just went out in California past couple weeks, and it's pretty bad.
Yeah.
As in Florida as well. But yeah. So.
All right. Well, we're coming up on we've been going at it. What do we got? We have any more super chats?
We got some super chats. Yeah.
All right. Let's cover
We'll
them.
get to
and then we'll let
those.
Melody. Of course, she's got it easy. She's an hour behind us here. It's only 9:15. She's got plenty of time.
I'm on
No, she's
Eastern
Eastern.
time.
Oh no,
Thank
Johnson
you.
City's. Oh, okay.
Yeah.
Yeah, thank you very much.
All
She's-
right.
she's
okay.
right with
Well,
us.
hey, you're right there with us then.
Yeah.
My apologies.
Sure am.
But we'll go ahead here. Charles, thank you again. I worked in logistics for a bit in the Marines, and the amount of money we waste so we don't lose our budget is dumb. Don't get me started on the VA.
Thanks, Charles, for your service. We appreciate you.
Thank you. And he goes on to say, by the way, I think the Fed is trying to correct the market, but the Biden administration is fighting it hard with the FHA extensions to win elections. And then you want to
We
say
appreciate your
comment
super
on that?
chat there, Charles.
Yeah, absolutely.
Your
And
support for our channel.
yeah.
Definitely. Thank you.
Oh,
for
for
that.
sure. And then Cov, another one. The only entity extending anything is the Fed.
Yeah. Thanks, Cov.
Yeah.
Appreciate your super chat, guys. It means a lot. I mean,
Yeah.
this is fantastic. Shows us that you really do appreciate our channel,
Yeah.
and we thank you for that.
Yeah.
Yeah. And we're very honored to have the audience that we do. I mean, to see you guys show up and spend your Tuesday night with us really means a lot. It definitely does. And we're going to keep bringing the information. I mean, it's hard. It's not always easy to be live on a Tuesday night. We've been trying to do it. We've done it now for over 3 years.
3.5. Yeah.
Yeah,
Wow.
I think
Just about getting up
so
on
we definitely appreciate our audience, and it's growing. I mean, we have I think over 70,000 subscribers now on our channel, which is
Amazing.
which is
is
telling me
amazing.
that we're hitting home to a lot of people, and I want to see us all do well. I want to see us get through this, and whatever downturn it is, and I think the positive here is that we will get through it. Some go through it a little harder than others, and it's tough around a holiday time too. I mean, this is a difficult time of year for a lot of people, and people battle depression, and it's real. And I think financial pressure, when we're dealing with other things in life, can really make it seem impossible, like it's no way out. And if you have to let things go, let them go, man. It's not worth life itself. We know that debt and financial struggles cause more divorces than probably anything else, and more addiction and drug and alcohol abuse and things like that. And what we really need to do is we need to pay attention to the people that are around us in our lives, our family and our friends that are struggling, and we just need to kind of embrace them and reach out to them and learn about what they're going through. And and the other thing I want to say is, guys, this time of year we have a tendency to want to go in debt, buying people gifts, and it's not the gifts that matter, man. It's it's the thought that counts. So instead of going out and buying $100 sweater and buying a shirt, you feel that you need to give somebody, bake them some cookies, and tell them you love them, and that's going to mean more to people than you going into debt. And when we start seeing the pressure from mainstream media about Black Friday and, Cyber Monday and all these sales and all this crap, what we really need to do is just tuck it in and get through, get your debt paid down. So I think that's the key here.
Yeah.
Are we missing anybody on the super chats?
I think we got them all. That was a little emotional. I mean, that's well, no, because it's real talk.
It is real talk. Yeah.
I
had a video last Thursday, man. I got so emotional I had to walk out. We had we had somebody. I'll just talk about it. We had a commenter that was saying it's our Thursday night Q&A, and Joe captured it. I got to the point, where I was going over one of the comments, and they were talking about they were in line of a grocery store, and the person in front of them had their credit card declined. And they walked away, leaving a whole cart of groceries. And this person gets up to the cashier and says, "Man, I must be bad luck. This is the second time I've had somebody in front of me watch this happen, where their card was declined." And the cashier said, "It actually happens a lot." And I was thinking, of how awful it is. And, to realize, and I mean, look, I think we've all been there at some point in our life, right? Some are fortunate enough to never have had a financial hard time. I've had them. And I think that unless you go through it, you don't realize, and I think it just kind of hit hard. And, I was talking about the holidays, and there it is, Joe's pulling it up. And I actually had to walk away. I couldn't even, I had to walk away from the camera. And Joe captured it, which it's kind of weird, but we left it in there because we wanted you guys to know, man, that, that we understand, we understand what's happening out there. So,
yeah.
And we've been there. Melody, thank you so much for your time. We appreciate you coming on.
Thank you so much for inviting me. It's always so much fun to chat with you guys.
And we love you. We love what you're doing out there. We're going to record, I think, later on this week. We're going to record a video for our Saturday. We're going to dive into some details, some stats. We're going to bring it to you in a little different format, guys. But Melody, we appreciate her work out there. And you guys cruise on over to her channel, show her some love, subscribe to her channel. She brings a lot of real data, boots on the ground, and she's a trooper. She's a warrior out there and somebody that cares about people. And that's who we like to surround ourselves with.
Yeah, absolutely. Very grateful, Melody, for your time and your expertise and in bringing the real talk and the real information. So looking forward to more in the future.
Yeah,
thank you,
Melissa.
So much.
Thank you, Todd.
Yes.
And thank you, Joe.
Yep. Thanks, Joe. We appreciate our team here. Hanging out on a Tuesday night. It's late here, almost 10:30. So, guys, we appreciate you. We love you. Keep those comments coming and share us. One of the best things that you can do for us is share us with your family and friends, somebody you think might enjoy hearing everything real estate and more. I mean, we talk about a lot more now lately, but we appreciate it. And we'll see you next time.
We'll see you next time.
Thanks, everybody.